Online shoppers are getting offers to buy now, pay later at checkout. But before you choose that option, make sure you know exactly what it means and if it's really a good option for you.
Today, we're diving headfirst into a riveting discussion sparked by Sylvio Tarez, CEO of VantageScore, about America's spending spree. Yes, we've hit the jaw-dropping $1 trillion credit card debt mark. Hold on to your hats because we're dissecting why younger shoppers are flipping the script, diving deep into buy now, pay later options. America's spending habits are in the spotlight as the nation's credit card debt hits an all-time high, breaching the $1 trillion mark. With consumers carrying more debt and increased balances, industry experts are concerned about the potential impact on this holiday season spending. VantageScore, a significant evaluator of spending behaviors in America, has noted a rise in delinquencies and a decline in balances. CEO Sylvio Tarez sheds light on these trends and their implications for different demographics, particularly younger shoppers. Sylvio Tarez, CEO of VantageScore, joins us to delve into the current trends shaping consumer spending. The discussion uncovers critical insights into the challenges faced by certain consumer segments, the impact of buy now, pay later options, and the repercussions of economic shifts on the holiday season spending.
If you look at the last 7 months, every month, delinquencies, late payments have increased. And if you look at how consumers are using their credit cards, there's some cause for concern. The average consumer is about 34% utilized on their credit card. That means they're using about 34% of the available balances. But if you look at younger consumers and what we call subprime consumers, those with a VantageScore 600 and below, there you're seeing utilization rates at 90%. And so that's causing some concern, and quite frankly, that's a bit of what's behind the spending numbers for the holiday season.
Particularly among two specific groups, lower-income individuals and younger consumers. The surge in delinquencies, coupled with declining credit card balances, signifies a growing concern within these segments. Among the concerning signs unearthed in this dialogue is the notable increase in delinquencies over the past 7 months. Each month has seen a steady rise in late payments, a red flag that cannot be ignored. Moreover, the utilization rates of credit cards among younger and subprime consumers are strikingly high, hovering at a staggering 90%.
Beneficial towards college students because a lot of people are struggling with money, especially with COVID. It has been able to branch out payments so that people can actually afford necessities such as some food, some textbooks.
Sylvio Tarez's discussion on consumer spending trends also sheds light on the proactive response of the financial industry in light of these evolving dynamics. One of the most striking responses is the discernible caution exercised by banks and credit card lenders. This prudence is evident in their reduction of new credit accounts issued, signaling a proactive stance aimed at mitigating potential financial strains among consumers. The industry's reluctance to extend new lines of credit reflects a calculated approach to risk management, acknowledging the potential repercussions of consumers facing increased financial pressures. This measured response stands in stark contrast to the surge in buy now, pay later schemes, which have garnered traction, especially among younger consumers. While buy now, pay later options offer an apparent reprieve from interest payments, the industry remains wary of the long-term implications, especially amid economic uncertainties. Tarez's observations hint at the potential risks associated with these payment schemes. Should economic conditions worsen or unforeseen financial strains emerge, consumers might find it challenging to meet the installment obligations, resulting in additional fees and potential financial distress. The contrasting trends between traditional credit and emerging payment options prompt a keen industry eye on consumer behavior. While credit card lenders pull back on new accounts, buy now, pay later providers witness a surge in usage. This dichotomy presents a complex landscape for the financial industry to navigate, balancing risk aversion with catering to changing consumer preferences. Moreover, the cautious approach adopted by banks and credit card issuers in reducing new credit accounts hints at a broader concern within the financial sector. It indicates a recognition of the potential risks associated with economic uncertainties and the need to safeguard both consumer financial well-being and the industry's stability. Tarez's insights illuminate the careful calibration within the financial industry in response to shifting consumer behaviors and economic fluctuations. The emphasis on risk mitigation and a measured approach in extending credit underscores the industry's recognition of the delicate balance between providing financial services and safeguarding consumers from potential financial strain in a volatile economic climate. Sylvio Tarez's analysis of the recent holiday season spending patterns offers a nuanced understanding of the complexities surrounding consumer behavior during this crucial period. Despite initial reports indicating an uptick in holiday spending, especially during Black Friday when adjusted for inflation, a different narrative emerges. While the figures suggest a 2.5% increase in holiday spending, closer examination reveals a more intricate scenario. Tarez highlights that beneath the surface, Black Friday spending, when adjusted for inflation, actually experienced a slight downturn. This discrepancy underscores the deeper challenges faced by specific consumer segments, particularly younger and subprime individuals. The implications of this nuanced observation are profound. It suggests that the reported increase in spending might not be as robust as initially portrayed. The impact is notably felt among economically vulnerable demographics, hinting at potential trouble for both retailers and lenders catering to these segments. The underlying trends, when dissected, indicate that the less affluent and younger consumer cohorts are feeling the economic pinch more acutely. This is reflected in their spending habits, which, when adjusted for inflation, reveal a less enthusiastic participation in holiday shopping compared to previous years. The analysis posits a crucial concern for both retailers and lenders. If this trend persists into the coming years, it could pose significant challenges for retailers reliant on holiday season revenue and lenders managing credit for these consumer segments. In essence, Tarez's evaluation of the holiday spending figures offers a sobering assessment, unveiling a discrepancy between reported spending increases and the actual adjusted figures. This exposes a fragile economic reality for specific consumer segments, raising red flags for retailers reliant on robust holiday sales and lenders managing credit for these financially vulnerable demographics. The implications of this subdued spending trend necessitate a closer examination of the economic challenges faced by these consumer cohorts and the potential impact on the broader economic ecosystem. If you found this analysis valuable, make sure to smash that like button and share this video with your friends and family. For more thought-provoking content on finance, consumer behavior, and economic trends, don't forget to subscribe to our channel and hit the notification bell.